Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Brian Joyce. He's a managing director on Nasdaq's market intelligence desk. We're here for the midday update. Brian, it's great to have you with me as always. And the focus has shifted a little bit today. Not so much rate cuts, not so much the consumer, but there's something in the conversation around PMI.
Yes, we had the global manufacturing data, the PMI data come out within the last 24 hours, just ahead of Jackson Hole, so at least we had something to look to because markets seem to be in a bit of a holding pattern ahead of Jackson Hole, which started today, but tomorrow's Chairman Powell's speech is really what all market participants are really focused on and what signal he may give regarding the future pace of rate cuts.
Yeah, I mean, the major averages are pretty much so flat.
Yeah, they were up this morning, then they went down following the negative PMI manufacturing data, and so they've been waffling around.
All right, let's take a look at that chart, our first one, U.S. manufacturing PMI. What's the significance of this here?
So this is just clearly, so what this shows is when this dips below the 50 level, that means manufacturing, in this case is the manufacturing PMI index, it is contracting here in the U.S. So we finally joined global economies whether it's Germany, whether it's China, other leading economies where they've already been seeing a recession, so to speak, in the manufacturing indices. So here that has now happened here in the U.S. Now the services side has remained positive and has, because of that, has held the overall composite index or the composite PMI indices in positive territory. And we can see that in the second chart where we're actually looking at both the U.S. PMIs and the Eurozone PMIs for the broader composite. If we go to chart 2 here, we'll see the U.S. PMIs. We made a new, we retested the low that was made back initially in May, and we retested it just now for July at 50.9. But what's interesting to me, and I think this is kind of not being caught by many, or certainly not being highlighted in the media, is that the Eurozone composite PMI bottomed back in January and has since been kind of basing in a sideways pattern. So if the lows are in, that I think is noteworthy because from there, you could potentially see a reversal, particularly if we have now talk, which is what we've recently been hearing out of Germany about a potential fiscal package.
All right, well, let's take a look at Germany in particular. This is the German Bund index. What are you looking at over here? Because it looks really, RSI of 15, right on the very low end.
So last Wednesday, just a week ago, the S&P 500 declined 2.9%. We had an extreme risk-off move in all global equity indices and all asset classes for that matter, largely driven, the headlines were attributing that risk-off move to two main economic data points. First, Germany contracted in the second quarter, just barely, minus 0.1% the GDP. And then out of China, we saw very weak retail sales and industrial production data. So that was the two reasons that most headlines were attributing to the extreme risk-off sell-off. However, in conjunction with that, we did have, just the night before, Chancellor Merkel from Germany made comments about she does not expect a fiscal package to be put together in the near term, at least not at this point. And I think that was a concern for many market participants because the response clearly overseas, there's a slowdown going on. It's underway, a manufacturing recession, which could potentially lead to much worse things in economic activity and maybe expand to the services side. And so when she said that, I think it really dampened the mood, and then we had that extreme risk-off move. The German bonds accordingly made new lows, and the very next day on Thursday, the 10-year German bond yield hit negative 71 basis points. More importantly to me is, or just as important, is the daily RSI, which measures the momentum, hit a 15 level, which is an extreme low. We haven't seen that since 2001, so we never got that low during the Great Recession. Last was in the fourth quarter of 2001, which was right around 9/11 and in the heart of the dot-com bursting. The previous time before that was in late 2000, and the German, the European stock indices and even the S&P 500 were already down between 20 and 25%. So extreme times in those instances, which is where we're seeing right now in the German Bund index. To me, it looks like we're at a potentially a low was made, not necessarily last week, but we're about to make a low in the 10-year German bond.
And to provide some context around it, as a technician, 30 to 70 is kind of the range that you look at to see if something is oversold or overbought. So if that is in fact the case, 15 points below 30. That's pretty significant.
Yeah, 30 to 70 is the traditional range that most technicians look at. Many also will use 20 and 80. When you get a dip below 20, that is really the significant move. However, a lot of times price, in this case yield, doesn't make a low at the same time that the RSI makes a low. So, and that was the case the prior 2 times where the German 10-year bond yield had an RSI of below 15. It actually did make a low. The last time it made a low within a week and then went on to a significant rally. And the prior time before that, it took about a month for the yield to make its low. So I wouldn't be surprised if we actually do see a slightly low in the German 10-year bond yield, but I do think we're getting close to approaching those extreme lows.
Okay, let's wrap up with our last chart here. You're taking a look at the 10-year spread here versus the bond.
Yeah, this is the 10-year Treasury versus the German bond. The rate differentials certainly have a big impact on FX markets, and as you can see, it has a very toppy looking pattern, what we technicians call the head and shoulders pattern, that formed over 12 months, ending in May of 19 when it broke down below the neckline at 244, 245. The measured move for that breakdown is in the 205 to 210 range. That is the minimum measured move, and we hit bottomed recently about at 2.22%. So I think there's more downside here. If the German bond is close to making its lows and is going to rally back, that could certainly be one reason to see this spread here collapse further. There's a lot to go on in the upcoming days and weeks. Jackson Hole is the immediate one. I think there's concern about Chairman Powell just at the last meeting. He had the hawkish cut. I would be concerned that he won't be as dovish as markets would like to see. Again, if that's the case, I think you could see another risk-off move, and maybe that's what sparks the new low in the 10-year German bond yield. But I don't know if it would last long. I have a feeling if that was to be the case, you'd see some sort of response.
I agree with you. Thank you so much, Brian, as always, for joining me. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.